Thanks for joining today. I'm Luke Vanderkitch from Channel Capital. Pleased to be joined today by James Wilson, Senior Portfolio Manager at JCB. Just flick forward to our disclaimer slides to keep our compliance people happy. I suppose if transitory was sort of the theme of 2022, it's probably fair to say that resilience has been the key word for 2023 so far. We're almost through a full rate hiking cycle now, and a lot of income's been restored to yield curves. So probably a good time to maybe take stock, have a little bit of think about what's ahead of us. So good timing to be having this chat, James.
Sure. Thanks, Luke.
So we've got a fair bit to get through today. James is going to talk a bit about where we are in the bond market, a bit about the outlook, some of the monetary policy effects. There's obviously a bit of a lag to those, so we'll get a bit of an update as to where we are today, and how those are starting to flow through to the economy. Some views on the prolonged period of interest rates that we've had, and how that may be comparing to some of the expectations around rate cuts and whatnot moving forward. We will look through our typical bond market scenario analysis as well, and give everyone a bit of an update as to that bigger picture view of the world as we're seeing things at the moment, and then maybe finish off with some comments around how you're managing the portfolio and positioning and whatnot.
Sure.
So a lot to get through. So we'll kick things off. James, maybe do you want to start with some comments on how you're seeing the market broadly and where things are placed?
Sure. Well, at a high level, I think sometimes the best way to look forward is to look back, and if we think about what's actually happened over even since March 2020. You know, we've seen pandemics, we've seen wars, we've seen nationalism, we've seen political polarisation, and everything's happening at warp speed. If you have a look at some of these little pointers up here, we've got record high credit card debt of $986 billion. That's hit $1 trillion overnight. And if you think about that, in the US, there's now actually the average credit card balance for in the US is $7,300, whereas the savings rate is closer to $5,500. So, you know, they're trying to spend their way out of debt, which isn't necessarily a great outcome. We've had a world of overshoots in this time. We've seen oil travel from, you know, minus $30 to over 120 and back to in the 80s where we are now. We've had the Bitcoin bubble. We've gone from, you know, 5,000 to 68,000, where we all wanted to be part of the big the bubble there, and until it all popped and went back to 16, and that's since recovered again. And now at the moment, equities are being led by AI, and you know it's a world of overshoot. Whether that continues or not is the big question. But at the moment, it's having a good go at keeping equities quite well supported. And all this is happening in a highly indebted world where the US mortgage is under trillions and trillions of dollars of debt. As said, high credit cards, governments are under debt, and we're in a time where unemployment rates are going fairly well, but we are sitting on great debt burdens, and I think this will provide headwinds going forward. We like to look at cycles in the macro world, and this is one of our favourite charts that we do look at quite often. You see that we generally find ourselves, and we seem to be circling between the late upswing phase and the economy slows phase, which moved to a recession. You know, we've had short rates obviously rising and seemingly peaking for the last 2 years now. We do think that, you know, we've seen the top in CPI and inflation globally, and we think that, you know, we are starting to roll over. The question is what's the cycle going to look like? And we look at 2023 as being much like 2007 potentially, which is where nothing really happened. But then going forward, everything happened. And so, as we know, you know, rates hit in the 5 handle over there. You could buy a 3-month T-bill for above 5% for over a year until everything came crashing down. Now, we don't know what's going to trigger that recessionary phase, but the lagged effect and variable effect of monetary policy means that these things do take time. And the question is whether we're going to get the soft landing or the hard landing, which is the market is working its way through right now. Thought we might just take a bit of time to have a look at where the economy is and what the data is saying. There's obviously a lot on this chart, so I'll try and pick out a few of the points that we are focusing on. But from a high level, our thesis has been that the UK and the Europe would go into recession first, and they've got big exposure to energy. They've got obviously they're against the US dollar. Then we think the US and then Australia would go into recession as inflation and jobs, unemployment rates did go higher. Looking at some of the unemployment rates, and you can see them through Europe, they are sitting at higher levels than the US, and all bar Germany. If we think about China, and this slide was actually set about 48 hours ago, so it doesn't have the last piece of CPI data in there, but we saw China yesterday printed PPI at -4% and CPI at -0.3%. Now, this is a bit of a worry for the global growth engine, as has been the case for the last year. China's got, they're lacking in stimulus. They've got really high youth unemployment. If you look at even some of the anecdotal data, so you've got 7-day moving average of their flights is less than 50% of pre-COVID. So, they're really starting to get a wriggle on post the COVID lockdown, and try as they might, they're going to take a lot more work to get where they need to. And then, the households are just risk averse and the saving rates are high. So what does that mean for the rest of the world where, as mentioned, that they are the engine room of the world and, the production side. So if they can't get off the ground, then it's going to continue to export deflation. If we look at the US, they just keep on keeping on. We've got the unemployment rate at 3.5, which seems to be pretty sticky down there. The inflation rate has dropped from a year ago of 9% down to 3%. This has been a very good story. What we do have coming up tonight is the latest inflation figures, and we're not going to be surprised if that does tick back up off 3% as some of the lower numbers. So we had a 0 as a monthly reading a year ago. That's going to drop out. So any sort of positive CPI reading tonight, we'll see that number tick up. And then the other thing about the US is the fiscal management, which has been a catalyst for fiscal deficit that they're running, sorry. It's been a catalyst for some of the recent sell-off and underperformance in bonds, as the Treasury is now going to have to increase the coupon size of their issuance, and someone's going to have to step up and buy those securities. One thing I would note, just finish off this slide, is that if you compare the CPI in the US and just the headline rate of 3% versus the central bank policy rate of 5.5%, that is now quite a positive real rate. So if the longer that we do stay at these levels, and assuming US CPI might stay a cycle between 3.5, the more restrictive that those rates are going to be, and the more that growth in the economy should slow down.
Yeah, so you mentioned inflation a few times in there. That's obviously been probably the most closely watched metric around markets for quite some time now. Obviously, every data print that comes out gets analysed to the nth degree. Maybe just want to step back a little bit and give some thoughts on the inflation dynamic at a higher level, and where you see that sort of trend progressing through the rest of the cycle.
Sure. So as we came out of 2020, we had, this is a chart of what we look at, which is the City Inflation Surprise Index. So what we mean by a surprise index is what the market and the forecasters were expecting versus what actually gets printed at that data print. And so what we saw versus from 2020 onwards was massive surprises to the upside. So that was on the back of goods getting expensive, reopening, the war in Russia and Ukraine, energy going through the roof, food prices going through the roof. And so, no one really expected, as the chart shows, that inflation would get to the levels it did, hitting 9% in the US and, 10 over in the UK. This is no longer the case. Goods inflation has pretty much come back to zero. Energy's come a long way off, although in saying that, we have seen it start to rise in the last month or so. So oil's, rallied 20% or so off its lows. The emerging markets have seen the same story. The US is is and will continue to be the leader in inflation markets. And so, generally where the US goes with the dollar being the world's currency, the emerging markets and the major economies are going to follow. So what we know about this is that we're no longer seeing surprises to the upside, which means we're not getting the volatility in the data, which means we're not getting, most likely aren't going to see the binary moves in the actual bond yields. So, of course, we went from, bond yields sub 1% and negative in most of Europe, and we've, sold off in the order of, 300, 400, 500 basis points across the world, depending on which jurisdiction you're in. So now that we've seen the inflation expectations start to come lower, finally you can truly say that as the central bank has wanted you to believe, that it has been transitory. And we don't by any means think that we're going to see inflation back to below 2% anytime soon. We think it does stay sticky. You've got things like, rents over in the US, they take time to roll off. The way that the rents work is that they're priced off CPI. So, when you look forward at rents, it's really hard to get that number down because it's being priced off the current CPI. So there's a big lag effect involved in that. And we are seeing signs that it will decrease, and as prices just get too high, people just can't afford to continue to pay these levels. So in time, it will come down. It'll stay sticky for a while. That means bond yields can potentially stay a little on the sticky side as well. We're not expecting the 10-year Treasury, which is currently trading around 4% in the US, to get to see any huge rallies anytime soon, but. At the same time, we think a lot is priced into the market. We don't think it can go too far to the top side. So our expectation over the next 3 to 6 months is we potentially cycle around here. So which is creates opportunities for active managers. But while it stays sticky and while term premium does come back into the market after many years of depressed bond yields, then we can probably stay around where we are. So just further to the inflation talk. So this is the Supercore CPI. So this is the Fed's Powell's favourite measure. As you can see, the number that we focus on here is the 3-month annualised, which is back to 1.4%, which is really getting a long way from where it was up in the sevens. A lot of work's been done in the monetary policy space. As I said, the headline level's gone from 9% to 3%. These are outstanding moves, and the central bankers, although they're not making many friends in hiking in the face of people and the cost of living that everyone is suffering from globally, it's been the right idea, and that will help the economies going forward. And so, as long as we trust that central bankers will continue to be inflation fighters, we believe that the battle's not necessarily over. The last mile is going to be tricky for everyone, but they're well on the way. What are the risks to our views? Well, the obvious one is energy and commodities. So, we've had oil set up 15 to 20% over the last month, and higher again overnight. We've had the commodity indices, like there's a Bloomberg commodity index that's up over 6%, and then the other one is rents, which I mentioned, and as I say, that will take time to roll over.
There was concern that with the tight labour market and price pressures that maybe we'd lead into sort of a wage price spiral that could exacerbate the inflation issue. Where are wages at the moment in that sense?
Look, wages are at the lower end of where they were a year ago. So there's no spiral in that sense yet. I think the thing to remember is when we saw COVID happen, and when we saw this spill and fill occur, so over in the US, everyone went out and sacked all their workers immediately, as opposed to Australia, where we furloughed them and set them on JobKeeper at the time, which we'll remember, and everyone was sitting having cafes on cafe lunches on ScoMo at the time. But in the US, it was a spill and fill, and what that did was cause a huge amount of wage inflation because people had to get rehired, and they were trying to find the best workers, and they had to pay up for the best workers to get them back into work off their couches. What seems to have happened this time, and why the unemployment rate is staying so low in the face of everything, I think the US employers have seen what's happened, and they're keeping their workers on, which means you don't get this reset of wages, and so that can start to ease off in time.
So it's probably a good time to move on to sort of central bank policy. I guess the consensus is that we're probably at or near peak rate levels in most of the major economies now. Is that your view, and where are you sort of seeing things heading from here from a policy perspective?
Yeah, look, I think we're definitely at the end of the cycle, or close to the end. Does that mean we're at the very top? Potentially not. The US isn't pricing a lot in, but as you can see by the steepness of the curve, this rate hiking cycle's just had unprecedented velocity and ferociousness, and they're doing everything they can to really try and slow down the economy. When you look at the Fed cycle, they've gone 500 points higher in rates. Australia's only gone 400, which is still an extraordinary amount. The reason the US can go higher, and the reason that their jobs rates is still continuing to be around that 3.5% is their transmission. So the risks to the US economy is via the corporate cycle. So when they borrow money to invest in people, in capex, in new plant, whatever it might be, they need to generally borrow for that. And so when they've gone out through 2020 and 2021 and even 2022, they've locked in for term at really low levels, despite the credit margins being wherever they might be. So at an absolute level, they're in really good shape. The risk will be when they do start to refinance. And so what you're going to have is margins are going to get squeezed. The corporates aren't going to like that because the equity market's not going to like that. What happens then? Well, you're going to have cuts in spending, so capex is going to be cut. At some point, jobs are going to be cut, and then the economy is going to slow. So these things are long and variable lag, as which was one of our favourite terms, but they will take time. At the same time, the FOMC is continuing on with their hawkish rhetoric. They don't want to let the equity market get away too far, although we have seen very good performance this year. They don't want wealth effects to get too far. But with the size of the balance sheet of their deficits, so they're having to borrow at very high rates, and then down to the consumer who, as mentioned before, we've got trillions of dollars in credit card debt, let alone their mortgages, which have hit 7%, which obviously only matters if you're getting a new house. But there's an incredible debt burden on the economy, and so in time, we just don't think rates can stay this high for a prolonged period of time. It will be not necessarily turning overnight, but the next move is potentially one, or we're very done. But the US is most definitely in peak data dependency. Over here, I think we're at a little bit of a different stage. I think we probably are done here. I'd be a little bit surprised if Michelle Bullock does join the board, heads up the board and becomes the governor of the RBA and makes too many surprise moves. She's coming along from a history of being with the bank for 35 years or so. So I think that it should be fairly status quo. The RBA had every right and every chance to hike at the last two meetings, but they chose to pause. They acknowledged that we've done 400 basis points. They acknowledged the fixed rate cliff that everyone has been speaking about for a long time. But they also, I think what they're looking for is the consumer. And retail sales at the last month was minus 0.8% month on month, which if you then have a look at what that looks like after immigration, that's a pretty horrible number. We're getting hundreds of thousands of people come into the country every year. They all need to buy things, to live somewhere, to eat, to use services, to spend their money somewhere. And so as a per capita, that they're quite recessionary values. The other number that's been quite focused on is the monthly CPI data. So looking back, even 6 months ago, the monthly CPI data was only fairly new to the ABS's folder of what they were giving out. Didn't get a lot of a look in, but then in the last probably 3 to 4 months, Governor Lowe has put a lot of focus on it, and as that has been missing to the downside, he's gained further confidence, as has the board. And I think, as I say, if with no rate hikes at the previous two meetings, I think that's a pretty big tell. I think the next live meeting will be Cup Day, if anything, because they're going to get another quarterly. I'm talking about the monthly initially, but they're going to get the more important quarterly CPI reading. So if that does surprise the upside, that they still have some bullets left to use should they need to. The other piece of data we're looking at, which is coming up in the next couple of weeks, is the Australian wages data. This is a quarterly number. This will probably be the first one, I'm pretty sure, that will include the 5 3/4 Fair Work wage increase. So that one will be looked at very closely by the market as well.
Just as a bit of a bellwether, New Zealand's always been an interesting sort of signpost for Australia to watch. Obviously, the New Zealand Central Bank moves a lot more quickly in terms of getting rate hikes through the system there. They've sort of entered that technical recession zone. That's right. Data's continuing to sort of soften there. Any expectations for what the central bank over there may do next, and does that have any sort of predictive qualities for Australia from your perspective?
Yeah, you're spot on. Governor Orr's always been one to run from one side of the ship to the other. He was the one who was talking about negative rates and going quite negative for the New Zealand cash rate back in 2020. They never got there, but now he's run all the way to the other side of the ship, and they've got their cash rate up to 5.5% very quickly. Their economy is slowing rapidly. A lot of the surveys are showing, falling consumer confidence, GDP is falling. Unemployment rate hasn't gone too far yet, but that'll be the next one to fall as well. And yes, we do look at them as a bellwether. When their CPI comes out, we often take that as an indicator of whether it's quantitatively correct or not. We often do take that as an indicator of where we're going to be, because our CPI follows not too far after theirs.
Yep. Maybe can touch a bit on how those rate hiking cycles have generally played out over a longer period of time. Sure.
So read a few interesting things over the week just on this chart, and it's actually a Deutsche Bank chart that we've adapted to ours. But I guess the story of this chart is that with every rate hiking cycle, and especially the aggressive ones, something does go wrong. Now, we don't know what's going to go wrong, or if something will go wrong even. In this case, we saw, of course, SVB go under, and another couple of banks, Credit Suisse at the time, back in March, and we thought maybe that was the end of it, a big financial crisis, but they've papered over the cracks, and the big banks have got bigger, and some of the medium-sized banks have probably started to lose market share. But we've got through that one okay. If I could just take a moment to read a couple of quotes, and I'll tell you the timeline afterwards, just from the Wall Street Journal. So they said the economy was gliding towards a soft landing. So that was in September the 18th in the year 2000. And we can see that was pretty much right on the dot-com bubble. The next one was Friday's stock gains were fueled by an unexpectedly strong employment report suggesting that the economy has enough strength to avoid a recession. Now, that was, of course, October the 6th, 2007 in the Wall Street Journal, and we all know what happened after that. So, look, we don't know what will be the problem, or, as I say, if there'll be a problem, but there's no two cycles that are the same, but they often do rhyme. So at some point, this will inflict damage on the economy. It doesn't mean it's going to happen tomorrow. We might, cruise through and get the immaculate soft landing. But I think in the back of everyone's minds that these are things that can really pipe up pretty quickly in the markets. Yeah. The soft landing headline is quite pertinent, given that's all we seem to read about today. Well, that's right. You could throw any of those lines into any of the Wall Street Journal or the AFR today, and they wouldn't look out of place. Very good. Well, we've got some numbers here in terms of how the market is pricing cash rates on a forward-looking basis. Do you want to just talk through how that's looking? Yeah, sure. So if we just start up with the US on the left-hand side, and you can see the current cash rate, or the Fed funds rate in the US is at 5 3/8, so just under 5.4%. There's not really any full hikes priced in, but what you can see is a rate cutting cycle being priced in. Now, something to think about here, and that they've got, in the order of 120, 130 basis points priced in of cuts by the end of next year. The way we look at this pricing, and you can see it is quite a uniform line, because bond traders especially like to have quite nice smooth curves. But what that isn't necessarily saying that we're going to have 120 basis points of rate cuts. What that could be saying to bond traders is that could be a 50% chance of close to 250 basis points of cuts. So it's very interesting. Do we think we'll get to there? Well, as I mentioned earlier, with the level of real rates where they are, the longer that inflation stays around that 3% level, and the longer that the Fed funds rates does stay up at 5%, it is it's quite tight financial conditions. So it's really something to think about. As you can see, the Bloomberg forecast of not that they're necessarily going to be right, but the forward forecast of bond yields have also got them trending lower over time, and that's in line with the cash rate. If we come to Australia, we've got that one last hike price somewhere probably again by the end of the year. That's probably not unfair to price one. I think that probably stays in the profile. We don't necessarily have a big rate cutting cycle priced in. So one thing to think about with our rates versus the US is just one of the metrics we look at is where the 3-year bond is priced versus the cash rate. So currently the Australian 3-year bond is priced at about 3.8%. So it's somewhere around 30 basis points through the cash rate. If you look at the US cash rate, sorry, I've got it here. It's in the order of 100 basis points through their cash rate. So if you think about that, or I think it might be, sorry, I've written down, it might be a little bit more. So if you think about that level, the Australian 3-year bonds are actually quite cheap in that sense, because they're not pricing in any of the rate cutting cycle. So there's definitely opportunities to be owning those assets, and from the way we look at it, we think that those yields, especially in Australia versus the US, due to the transmission mechanism, is fairly sufficiently restrictive to get to slow down, first of all, inflation, also the economy.
Okay, it's interesting. We'll get a bit more into how you're positioning the portfolio towards the end, but it sounds like there's some value at the front end. So just from a portfolio construction perspective, just in terms of for people that are working through their asset allocation process and trying to work out where they may not want to be overweight and underweight, can you just give us a sense as to how bonds are priced at the moment relative to some of the other major asset classes like equities and credit?
Yeah, sure. So at current levels, and this was, of course, almost a month ago, but it's not too dissimilar as far as levels go. You can see that the bond yields versus the share market dividend yields is not too dissimilar. To us, this is saying that the credit stack's upside down. So, previously, when rates are at zero, you should be buying the higher yield asset, which is, you're going to be rewarded to be an equity owner. At the moment, with where the value in Aussie 3-year bonds are, and the same goes for the US market as well. We've got we don't have the chart here, but we can provide that upon request. You can see that the yields that you're picking up on the bonds is very compelling compared to equities. Same applies to cap rates in properties. Various asset classes are really now coming into line with where the bond markets are. And the thing to think about when you do think about bond yields is, and this goes for US deficits, for example, and as we've been saying, there's a huge amount of US issuance to come. At some point, bonds will clear. There is a price that's going to cheapen up, but bonds will clear at some price, and someone will buy the US Treasuries and the Australian government bonds, for that matter, at a level. The question is, where does this money come from? So if you're seeing a yield of close to 4% for a US Treasury or an Aussie bond, that money has to be coming either out of credit, has to be coming out of equities, has to be coming from somewhere. So at some point, and we are seeing it through the asset allocation means that we see from around the grounds, it becomes a very compelling asset, and we expect that to continue. over time. So yeah, as I said, that's probably covers that.
Strong, good relative value on the yield side of things. What about credit? How are we seeing credit spreads at the moment?
So there's two different things to look at when you talk about credit. There is the price of the securities and what it's going to cost to lend, and then there's also the appetite and availability of credit. And they're although they fall under the same banner, they're two different things to think about. So when we look at the credit spreads currently, historically they're at very, very low levels. You've got the BAA minus, which is some of the lower rated credit. It's very expensive compared to where it is in downtimes. You can see the periods through the 2000s, through 2007, 2008, and then again through the COVID period. And we think you just need to be quite wary of credit spreads. They've been extremely resilient so far, as there's been a big wall of money behind them. But as yields do go wider, you need to be compensated. Because if you're getting 100 basis points over a treasury at 1%, that's very different to getting 100 basis points over a treasury at 4%. So we're just very wary that these things can cheapen up in the event of a downturn, but also just as a relative investment option. The next chart we've got is actually talking about credit availability, and this is from the Senior Loan Officers Survey, which is a survey done with the big banks over in the US. And this chart actually maps out the demand for loans across, if you look at just down the bottom right-hand side, which is the key. So the blue line's across large, medium firms, the orange line is across small firms. But this is what loans are actually being offered out to corporates. And as you can see, that demand's collapsed. So this comes from not only SVB, where banks aren't willing to lend as much, but the demand is falling away as well at the high rates. As you can see, again, through the recessionary periods, we're getting to those levels where the credit's not flowing through the economy, which means, again, we're not getting investment, we're not getting capex, we're not getting job hires, we're not getting expansion of businesses. So the credit mechanism is the lifeblood of the US economy. And if this isn't happening, then we're going to come to a grinding halt pretty quickly.
Yeah. So maybe if we just try and bring all of that together, I think the scenario analysis that you guys do is a really good way of wrapping it all up into a sort of succinct sort of way. So maybe you can give us a bit of an update in terms of how you think about some of those scenarios, and then maybe we can come back to how the bond market itself might function through what's ahead of us.
Sure. As it comes up on the screen.
Yeah.
I might have to hit a few.
There we go.
So some of the proprietary work we've done here at JCB is to map out the returns on the index of the Treasury index looking forward for 1 year. And so what we're saying is that if we look on the top left-hand side, that they are the yields of the cash rate 3-year bond, 10-year bond and 30-year bond, and we've extrapolated that out just in a linear fashion. What returns you're going to get in 5 different scenarios. So if we take the central scenario, that is saying that the market's going to behave as priced, inflation's going to settle towards the 2 to 3% band, soft landing for assets, low growth economy as the market expects. That's the 10-year yield sitting at around 4.02%. So that's as at the 30th. There's the returns on the bottom. Once we actually look at how that performs over the full year, just sitting there and assuming those yields do not move, which of course is never going to happen, your bond portfolio will get a return of 4.1%, which is fairly solid over time for a defensive liquid asset. Were there to be, I won't focus on all of them, we'll just look at the left and the right tail. In the event of an extreme energy rise, so inflation again takes off, some global conflict, deglobalization, we'd expect, as the arrows show, Fed funds keep rising, which means global cash rates keep rising. we'd expect risk assets in that time to get hit. Credit spreads would widen, government bond returns would also sell off, so we're going to lose money. Based on the yield that you're going to be picking up and the attributes of fixed income, your portfolio within the bond market of the index, so this is aside from any active management, would return minus 1.4%, which I dare say is likely to be potentially better than what you're going to get from your risk assets. At the other end of the chart, if the world does come into some strife and unemployment rises and we see some big credit defaults and we see unemployment rates rise and a rate cutting cycle, based on where we are right now, we're saying that the 10-year bond yield would get to in the order of 3%, so roughly 100 basis points. The 3-year bond yield, as we forecast there, and these are just scenarios we've created just to as estimates. If that rallied 150 basis points, curve steepens, then you're getting a return of in the order of 10%. So there's plenty of upside to come in besides the left-hand tail. You're getting a great return in any of those scenarios. And as I say, in the left-hand tail, you're probably okay at down minus 1.4% versus what your equity part of your portfolio is doing.
Yeah, and it's interesting to note that even getting to those double-digit returns doesn't require bond yields getting back to zero. It's right. You still got a 10-year at 3% in that scenario. So there's a fair amount of cushion in the market at this point, and maybe that's a good point. Just want to flick back to this slide on the sort of bond market returns over a number of cycles and just sort of how that plays out into returns to investors. You want to just talk through that experience and
sure
the sort of self-rebalancing nature of bonds?
That's right. So as bonds do sell off, what they're doing is actually resetting the yield. And so they're a self-correcting asset. So if you go back to 1994, which was the previous big bear market in bonds, and 5.7% doesn't actually sound too bad compared to what we saw in 2022 now. But what we saw in that big sell-off, and that was, the RBA went 275 basis points, so nothing compared to what we've done. That was the start of the big bull market in interest rates. So, we went from, we could see the first 3 years of returns were, averaging over 14% based off the higher yields. After each cycle, when there's a downturn, so we saw 99 was a downturn, we then rallied up following that. 2009 was a downturn as we sold off, and we've rallied after that. So what we've now done is we've reset the capital structure of bonds. We've gone from, a 1% handle or so to a 4% handle in Aussie treasuries, Aussie 10-year bonds, US treasuries. So we'd expect now with those levels and the nature of the asset class, that we'd expect that performance does continue to follow. And if we just nick to the next scenario analysis once again, we did these numbers as at this is the most recent chart, but we did these numbers as at 31st of December 2022, and that was expecting a return in the order of 4.3%. As at today, the index has done about 2.1% or so, and that includes a little bit of curve flattening, but basically the 10-year bond yield is exactly where it was at that time. So sometimes it's a theory, but it's actually mathematically proven that if you just sit in the asset class, you'll clip the yield and the carry of the portfolio.
Yeah, so about halfway through the year, and we've done about half of the forecasted return. So it does, the math works.
The math works.
Pleasing to see.
That's right.
Okay, well, we've got a few minutes left for questions. So please, feel free to shoot through any questions for anyone that has anything they want to have answered. Maybe just one to kick things off from me. I think you mentioned it at the start, the changes at the BOJ with sort of starting to walk their way back from yield curve control in a very slow and measured sort of fashion. The market reaction has been a bit more, say, volatile. What's your take on on that policy change and how that may filter through to markets looking forward?
Sure. So with the differential in cash rates between the high yielding economies such as the US and Australia versus Japan, that creates a big cost for Japanese investors to, it creates a big benefit for Japanese investors to actually invest has been offshore. What we found with the increase in yields in JGBs, so the Japanese bonds, has actually been, it's more preferential for them to be investing in their own market. So one risk of the change to yield curve control is that bonds do start coming out of Australia and they start investing in their own markets. But quite to the contrary, the last 4 months has actually seen buying of Australian bonds net out of Japan. Do we think that they're going to start selling all their treasuries? There's no way that they're going to sell all their treasuries. It's too much. The market's too big and too dominant in the US. Will it see a reset in bond yields? Yeah, look, it does have an effect to weigh on yields for sure. Most of what we saw, though, happened at the time and it will be ongoing, but the way that they're flexibly buying bonds on a day-to-day basis means that the bond market will continue to be supported. And although they tweaked the level from 0.5% to 1%, they're stepping in well before that. So effectively, they're saying that 1% is a hard stop, but below that, they're still going to continue to support the market and to try and keep getting their inflation higher.
Yep. There is a question here about how you're positioning the portfolio at the moment, which is a point we didn't get to. So good question. Do you want to just talk through maybe, sort of from an outright duration perspective, how you're positioning across the curve? I know that we sort of found a bit of a trading range around that 4% yield marker on the 10-year. Is that something you guys are looking to exploit a bit, or how are you sort of thinking through things?
So when we think about portfolios and the way we add to the index duration, so the index duration is in the order of 6 years, let's call it, just for a rounding purpose. We play long and short around that range depending on what's happening. So if you look at the current state of the market, there's reasons to be short and there's reasons to be long. If we think about, first of all, the reasons to be long, at a macro level, we've seen the peak in CPI. As far as we're concerned, we're fairly confident of that. We're seeing disinflation in services. We're seeing, rent start to roll over, as we spoke of earlier. We've got the low PPI in China and other countries and through Europe as well, which precedes CPI. So that weighs on inflation, which keeps bond yields lower. We've got the relative value, as far as an asset allocation goes. There's the continued asset quality and defensiveness of the asset class. And overall, we see 4% as sufficiently restrictive for if you look back long term. You've got real rates, as I mentioned earlier, real rates are also quite restrictive. And then at the same time, you've got the consumer deteriorating. Reasons to be short, you've got, obviously, the US has got the big fiscal issues where they're pumping out massive deficits at times when unemployment rates are 3.5%, which is going to be a massive problem in the event of a downturn. The sticky inflation keeps us not from going gung-ho into buying duration. Commodities are a little bit higher, the BOJ, and then potential restoration of term premium. But overall, we believe that these conditions are really good for active managers. Medium term, we love bonds, and then we're not just saying that because we're a bond manager, but there's you're getting a liquid defensive asset that's yielding 4%. It's quite attractive. We do like playing the ranges at the moment. So if we're talking just in a tactical sense, we really like adding to duration at 4.25 and removing duration or shortening up duration at 3.75 because it's going to take one big breakdown to really get through those levels, especially with the global supply story. As far as curves go, we like 10-year versus 30-year steepness. We think 10 years should outperform 30 years at the end of rate hiking cycles. So if you go back to 2006 and 7. So we didn't have an Aussie 30-year bond at that time, but the US at the end of their hiking cycle in 2007, their 10s 30s was at a close to flat or 5 basis points. That very quickly got up to 80 basis points and then up to 120 after that. So we really like that. That trades as a spread to the Australian curve, so it trades at about 20 basis points difference over time. So we'll continue to keep that on and look for levels to take that off at the right moment. And then we still don't mind spread product in the shorter end. So you're getting the front.
That's your Supras.
That's Supras semi. So we own them out to about 3 years just for a bit of extra yield pickup.
Any particular names that you like most in that space?
We like Queensland and Western Australia more so over the Victorians, who seem to be very good at issuing more and more debt.
Spending money, yeah, absolutely. Unsurprisingly, there's a question here around the Fitch downgrade of the US sovereign downgrade. It's been what, 10 or 12 years since the original downgrade. So
2011, I think it was.
Better say it's been a long time coming. Any thoughts on that implications? Is it something to worry about, or is it just a good one for the headlines?
Look, I don't think it's a huge impact on the market. At the margin, they're downgrading because the deficits are too big, because the management of the balance sheet is not up to scratch in the governance side. It had a mild impact when it was announced, but if anything, and we saw this back in 2011 when S&P downgraded the US, it actually hurts risk assets more, and we saw outperformance in the bond market. So Fitch is probably not seen as the top tier ratings agencies. Not that we can necessarily trust all the ratings agencies after the GFC, although maybe we're forgiving them finally. But they're probably the third tier anyway. So it's noted, but it's, as I say, it's probably more your issuance programs and your increase of the coupon issuance size that will be a bigger driver of weight down in US Treasuries. I wouldn't think there's any or many or any investors that would have to sell down their holdings of US Treasuries based on Fitch's.
Yeah. A lot of those mandates have been rewritten post S&P to remove that requirement, right? Yeah. There is a question here on issuance as well, so maybe we'll take that as the final one. I know we're a few minutes over, but yeah, I mean, obviously the US Treasury announced a massive amount of issuance to come at whatever $1 trillion. Or thereabouts, which I think had a much bigger impact on market pricing. What's your take on the supply dynamics?
Look, we look at that as part of our process, which does keep us from getting too overly bulled up in bonds, because we look at all supply, we look at where the demand's coming from, we look at momentum, we look at pricing, we look at all sorts of things. So it does go into our process. One thing to note, and this was the first week of the increase of coupons. One thing to note is that they've been the strongest uptakes since January for the 10-year, for example, last night. So they've had the most bidding, as I alluded to earlier. There will be a clearing price for all government bonds. Where that money comes from is the question. But as it stands, now that we've got that 4% handle on, you've got foreign buyers, you've got banks, you've got marginal buyers stepping in at 4% or whatever that level is to take down the auction. So they look at some of the stats they look at is indirect bidders, and that's effectively non-banks who are buying treasuries at auctions, and these are some of the highest, as I said, since January. So as it stands, they will find a level, but it will definitely keep us from rallying too hard.
Yeah, it's probably not surprising as well. Just, I mean, from what we see in the market here, talking to a lot of our larger institutional clients in particular, there's definitely a lot of appetite for reweighting or reducing some of the underweights to high grade bonds at the moment. So not surprising to see. All right. Well, thank you everyone for joining today. Hopefully that's been useful and insightful. We will send around a copy of the slides and a recording of the presentation we made available as well. If there's any questions or anything we can help you with, please reach out to one of the friendly faces at Channel Capital, and we'll be happy to help. But otherwise, we'll hopefully speak to you all soon. Thanks very much. Thanks, James.
Thank you.